Okay, well, let's go ahead and get started. Thank you so much for joining me today. This is Briant Sikorski. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. As a wealth advisor, I help clients work toward achieving their financial goals. I will often do this through some sort of planning, whether it's a financial, insurance, retirement income, or education savings planning. Possibly also asset and income protection through life, disability, and long-term care insurance. Investment management, including brokerage and fee-based advisory investment management accounts consisting of stocks, bonds, mutual funds, and exchange-traded funds. And finally, tax-deferred retirement income strategies, including fixed index, and variable annuity products. Now today our topic is, company-sponsored retirement plans. And on the screen at the moment I am showing essentially my biography, and I'm not doing that to laud myself, but rather I wanted to show you at the top where it says Briant Sikorski, AAMS, CRPS, MBA. And what that means is that AAMS stands for Accredited Asset Management Specialist, which means I've undertaken additional training and certification and continuing education on the topic of portfolio design. And secondly is the listing of CRPS, which you may see in the body of the document, as listed as a Chartered Retirement Plans Specialist. And what that means is that I have again undertaken additional training, continuing education in the area of retirement plans. And the reason I bring that up is that retirement plans are, I'd say, on the spectrum of investment alternatives are pretty high up there on that list of confusing and complicated products. So hopefully in this webinar I'm going to go through some of the different types of plans, and hopefully that will help you better understand them and do one of two things. Either you may elect to, if you're a business owner, you may elect to offer a plan. If you're an employee, at least I think you might understand your plan a little bit better. I've got my camera on, I've got my headphones here. I look like I'm ready for NASA, but what I found is that headphones like this do a much better job of recording, and I wanted to share with you, while all of you are currently muted, I am recording this webinar, and at the conclusion you'll get an email sent out to you saying thank you for attending, and it will have on it any attachments, including a recording of this presentation. At the conclusion of this presentation, I will also upload or transfer this this webinar to my YouTube channel, and you can get to it by going to my website, briantsikorski.com. In the upper right hand corner you can click on the little YouTube icon. So with that, we're going to jump over here to the topic of retirement plans. And you can see here that this presentation in the lower right-hand corner is illustrated as being provided by the Principal Group. Principal is an insurance and investment company that is kind enough to provide independent advisors like myself with this presentation. So the first thing I can share with you is that whether you realize it or not, there are a lot of retirement plan options out there. They all vary a little bit differently. They all have unique characteristics. They all have different features, and the objective of having those different features is to be able to meet varying and different needs. But what I can tell you is they all have the same end goal, the same end objective, and that is to help employees prepare for a more financially stable retirement. And sometimes you may hear the phrase retirement readiness, which we use, or I've heard within the industry, to describe particularly the situation of employees utilizing a company-sponsored plan to be ready for their retirement. Now, the other thing that I find interesting is that many people don't realize how flexible and fluid and how easy, if you will, it is to sponsor a retirement plan. And on the list here, you can see that just about any business entity except for government employers can sponsor a plan. Those include corporations, partnerships, sole proprietorship. That's kind of interesting because that sole proprietorship can be, I jokingly say, your lemonade stand. And that's absolutely true. As long as you are willing, in so many words, to report your income, you can sponsor a retirement plan for your own company, even if that own company is just you. Limited liability companies, that's myself. I am a limited liability company. I have my own company, and I have my own company-sponsored retirement plan. Now, the only person that participates in it is me. If you're an Indian tribal government, and if you're a non-governmental tax-exempt organization, you can sponsor a retirement plan. And I think the only real difference here is we're migrating to that next step up from an individual plan like an IRA to a business-oriented plan like some of the plans we're going to discuss today. So what are some of the benefits of a company-sponsored, I want to emphasize that, company-sponsored retirement plan? Well, number one, the contributions that the employee, and if that's just you and you're the CEO and janitor of your own company like myself, you can make contributions that are tax deductible if you elect that avenue as opposed to the Roth avenue that has no tax deduction. If you are looking to hire employees, this can be used to attract and retain employees and keep them. And it can also be an incentive for the key employees that you have within the company. So that's very important. So what are the parts of the retirement plan? And I only bring this up because there can be some confusing nomenclature. And again, you can refer back to this later if it gets overwhelming. But it's worth noting that there are several parts to a retirement plan. All plans include record keeping of an individual's account or the promised benefits. There's usually some kind of trust or other legal structure put in place to protect the assets. And there's the investment options, if appropriate, that the employees can choose from. Now, this middle section, we see the word compliance and plan design. Compliance just assures that all legal and regulatory processes are being followed. Plan design is a document and a process that shows and describes who benefits from the plan and how. We see that there is a provision for participant education, so for the education of those employees and participants in the plan. And finally, actuarial services, which provide reports, notices, and consultation on plan funding, how to do that in the most efficient way possible. Well, there are two overarching categories of retirement plans, company-sponsored retirement plans. And those are commonly referred to, as you see here on the left, as qualified plans. There's also another set of plans called non-qualified plans. So let's start with qualified plans. Qualified plans generally follow ERISA. ERISA stands for the Employee Retirement Income Security Act of 1974. Defined contribution and defined benefit plans are both qualified retirement plans, which we'll explain what defined contribution and defined benefit are. They offer tax benefits for employers and sometimes for employees depending upon the plan. However, to be considered a qualified plan, a retirement plan must meet several criteria and comply with specific rules to ensure fair and equal access of that benefit by all employees. Now, conversely, I just mentioned qualified plans. Non-qualified plans fall outside of that ERISA guideline, so they're exempt from qualified plan coverage and Internal Revenue Code limits. With a non-qualified plan, employers can make contributions. They can also let key employees defer up to 100% of compensation in excess of qualified plan limits on a pre-tax basis. So you may have heard the phrase deferred comp plan, and that's where something like this would fall. Okay, so now that we've covered the rudimentary basics of qualified versus non-qualified plans, let's dive into different types of qualified plans. So, with a defined contribution, or often known as a DC plan, employees can contribute to their accounts within defined contribution plans, and this gives them potentially some tax benefits. An employer's contribution is generally described or defined in the plan, and that's where the term defined contribution comes from. So regardless of how the investments in the plan perform, the employer still is only responsible for putting in the contribution amount they've committed. This is the biggest difference between a defined contribution plan and a defined benefit plan. Because of this, the investment risk in defined contribution plans is shifted from the employer to the employees as compared to a defined benefit plan. There are still overall risks in defined contribution plans for employers, and those are typically fiduciary risks. And fiduciary risks mean that if they don't follow the appropriate guidelines, reporting requirements, etc., then they can be held personally responsible for losses in the employee's accounts. Defined contribution plans are not guaranteed by the Pension Benefit Guaranty Corporation. And finally, total contributions to the plans have to stay within certain limits. It's not like an unlimited bucket in which to dump money. So what about defined benefit or DB plans? Well, most people, when they hear the word defined benefit plans, think of pension plans. So you work for a company for X number of years, and when you retire, you get a monthly check from your pension. Your benefit is defined in the plan, so that's where the term defined benefit comes from. Unlike traditional defined contribution plans, in this case, employees do not contribute to a defined benefit plan. Usually, only the employer contributes, and the calculation for how much they have to contribute is determined by using a formula that considers various factors as defined in the plan. Because of this, a defined benefit plan puts much more risk on the employer and less on the employee than we saw a little bit ago with defined contribution plan. Each employee's benefit is generally based on service coupled with their historical compensation. Benefits are guaranteed by the Pension Benefit Guaranty Corporation. However, these benefits may be limited to some extent per participant. Particularly if, well, back years gone by when we had a number of airlines in the airline industry declaring bankruptcy, and when a company declares bankruptcy, they can offload their pension obligation, and that's what a number of them did. A little perverted use of the law. It really wasn't meant to, as a bankruptcy, become more cost competitive strategy. It was really designed that way to protect the employees, but a number of companies did it. Finally, or next, excuse me, are individual account plans. Now these are unique in the fact that unlike what we've discussed before where the plans were created by the employer for the employees, these are individual account plans. These are simplified retirement plans that are usually used by smaller employers or people who are self-employed. With these individual account plans, the contract is between the employee and either the bank, insurance company, or investment firm that are holding the assets. The plans offer much simpler design, much easier adherence to compliance, but have significantly less flexibility. For instance, the employer has no control once the contributions are made. Finally, individual account plans are mostly used by smaller for-profit businesses like sole proprietors, partnerships, S-corps. So let's look at a couple of these individual account plans. So the first one here is called a simple IRA plan. Simple, only in the government, stands for Savings Investment Match Plan for Employees. Wow. With these, funds are invested in IRAs, and this is key, individually owned by the participants, or the employee in this case. All contributions are 100% vested, meaning the employee gets to keep them if they elect to leave the company. There's no waiting period or measuring period. You have to stay 1 or 2 years after we make this contribution. The participants or employees here defer their pay into these simple plans before taxes, and this is key, employer contributions are required, although they are tax deductible to the company. And they're designed for employers with less than 100 employees, and they have a limit of how much can be contributed, and that amount is $12,500 per year per employee. Now you notice that we saw up here a little bit ago is it says employer contributions are required. So typically with a simple IRA, these are I see a lot of these plans used by professional organizations, attorneys, dentists, some aspect of healthcare or physicians, where you typically have a measurable difference in the compensation of the management team or the ownership team as opposed to the employees. Like within a dental practice, a dentist himself might make $200,000 a year, but he may have 2 or 3 or 4 hygienists or administrators or clerks who get paid much less, maybe only $20,000 or $30,000 a year. And with a simple IRA, that business owner, as in this case, that dentist, is allowed to fully participate in the plan, and in exchange, that business owner is obligated to either contribute 2% of employees' salary per year or match up to 3% of employee salary per year, provided the employee has elected to make that deferral. So if I am an employee and I'm making $20,000 a year and I put in that 3%, at $600, then the company is obligated to match it. Each year, the employer can make the decision of whether they want to adhere to the 2% contribution regardless of what I do, or 3% match, provided that I do so. Now, just to confuse you even more, hey, look at this, simplified employee pension or SEP plan. Well, let's go back here again, back to our, where do we, oh, this is simple, wait a minute, this is called a savings investment matching plan for employees. Now we have something called the simplified employee pension or SEP plan. I only bring that up because only in the government could you have so similarly named programs. Now, in this case, a SEP IRA is measurably different because all of the contributions are being made by the employer. So the employer, it could be just me. So let's say it's just me, and I have my own company and I make $100,000 a year. I could contribute on a tax-deductible basis $25,000 a year from, technically, not from me, technically, from the company. Now, if it was me and you, if we were partners, and let's say I made $100,000 and you made $50,000, and I decided to put in 10%, or take from the company's coffers a 10% SEP contribution, well, then I could take $10,000 from me on my behalf, if you will, and $5,000 on your behalf. So whatever the if I'm going to call it ownership or management group do, they have to do for all employees. So you can see this is typically only used by one-person companies, maybe a family-run business, you know, where mom and dad and 2 kids own a dry cleaners. But it's not typically used where you have, I hate to use the word strangers, but non-family employees that maybe aren't going to be here for a long period of time, because you can see here also all the contributions are 100% vested. So as soon as you give it to me, I can skate out the door. It's very, I hate to say this, simple, because there is no Form 5500 filing, which is necessary on some plans we're going to talk about next. So the next area we have are the employer-sponsored plans. Remember, just a minute ago we talked about the savings incentive match plan, or SIMPLE. Then we talked about the SEP IRA. Those were kind of individual sponsored plans where the employees can pick their own investments, a lot of flexibility. It's a little different. These are employer-sponsored plans in which the assets are held in some kind of trust or insurance group annuity contract. The plan sponsor has very significant responsibilities, but also a great deal of control, much more flexibility in terms of plan designs. But on the other hand, there are requirements to adhere to non-discrimination requirements, and large corporations can in fact have, multiple plans. So when you get into this kind of scenario, this is much more, these, I should say, are much more common with larger corporations. So if any of you have heard that phraseology 401k, or if you've ever had one, this is what I'm I'm referring to here. And lo and behold, our next screen is a 401k plan. So you probably heard about it. This is a qualified plan. Contributions to the plan are generally, although not always, but generally made pre-tax. For 2018, the limit is $18,500 a year. Once an individual turns 50 years of age, the IRS allows them to make extra contributions to catch up on their retirement savings. The plan doesn't have to allow these, but most companies do, and that amount is typically $6,000 a year. Employers can choose to make contributions if they want, and they can make those contributions subject to vesting. 401ks do need to go through non-discrimination testing to ensure the plans don't favor highly paid employees. So we saw previously that simple IRA for a small company with large disparity in perhaps compensation. Well, you could see where a plan like this very much might not be applicable in that disparity of wages, because if you have a scenario where none of the $20,000 employees, $30,000 employees are contributing, you're making $100 and you want to pop in your $24,500 and none of the employees do, then you'll get a notice from the Department of Labor in the fall saying, hey, wait a minute, that's not how this works. And you may be required to take back, subject to taxes, any money that you had deferred throughout the year. That actually happened to me, I want to say twice in my career, where a large company did not get enough lower compensated employee participation such that the higher paid employees had to take back or receive back on a taxable basis some of the money they had planned to set aside. Now, safe harbor plans refer to a set of requirements that, if followed, assures the plan sponsor and the plan meet compliance non-discrimination requirements. So remember how I told you before that simple IRA, the higher compensated dentist, doctor, attorney could fully contribute even if their employees did not, provided they either contributed 2% of employee salary or matched up to 3%. Well, in this case, if the employer agrees to contribute 3% or match up to 4%, they can now participate in this 401k plan without concern of refunding of money. So that safe harbor allows them and allows highly compensated employees contribute more than they normatively could under just a normal 401k plan. You may come across this concept of automated plan features. Over the last 5 or 10 years, the Department of Labor, particularly during the previous president's administration, was very much involved or heightened scrutiny of company-sponsored retirement plans. I think a lot of that came about as a result of the Great Recession of 2008. But there was a time when once you were an employee, you joined a company, you might have had like a folder in your new hire paperwork that talked about your 401k plan, but nobody really encouraged you, much less hounded you to participate, number one. And number two, even if you did, there was no, your money often just went into a money market. And obviously a money market earning less than 1%, which would take 78 years to double your money, is not a good place to put your retirement money. So to help employees get past their own inertia, the Department of Labor enacted a number of different rules and regulations that do things like, number one, automatically enrolls employees in the plan. The employees actually have to opt out. Number two, a set-up defaulted deferral amount. So let's say 5% of your salary is automatically going to be deducted unless you opt out. So again, the participants may opt out, but that takes some effort, and sometimes they won't do that. Also, again, as I mentioned, whereas previously perhaps the money just went into money market until the employee took some action, now there is a default investment option. So instead of going into money market, it will maybe go into a growth and income mutual fund that's appropriate for a 35-year-old employee. And some plans will also often have automatic deferral increases so that it only defers 5% when you're younger and 6% when you're older. So it's really positioning you for that retirement readiness that we talked about. I have personally run into an investor who had a 401k that he got around to investing in, but 20 years later had never made any changes, so his investment stayed in a money market earning 1% as of a couple of years ago for the better part of 10 or 12 years. So that's changing today. One other option for employer contributions is just plain profit sharing. This plan can be stated as discretionary, stated or discretionary profit sharing formula. The contributions themselves are not tied to salary deferrals, and the requirements may include active employment on the last day of the plan year and a minimum number of hours completed. And the plan must preemptively let the employee know what these requirements are. So this is a little bit like that SEP IRA, where essentially the company, here in this case with profit sharing, is just going to announce a 5% profit sharing. So if they do that, then the company must contribute 5% of every employee's salary into some kind of profit sharing plan. If I'm making $100,000 a year and you're making 50, and they declare a 10% profit sharing, I'm going to get that $10,000. You would get $5,000, or the opposite thereof. Next, we have a defined benefit plan. These are what you probably recognize more as a pension plan. These give employees a solid foundation for retirement. They're designed to guarantee employees a specific amount of income at retirement, almost like Social Security. This amount is typically based on compensation, years of service, or a combination of both. And the employer makes contributions based on actuarial calculations, meaning what is the age of this current employee, how long has he or she worked here, how long do we think they're going to work here, and when are they going to die. So they invest in long-term employees. These are the plans that General Motors had and AT&T had, and these are plans that are really much more commonplace with Fortune 500 corporations per se. These are typically guaranteed by the Pension Benefit Guaranteed Corporation as well, if for some reason the company were to declare bankruptcy. Cash balance plans are starting to become much more, commonplace these days, because with a lot of the contribution limits to many retirement plans have not really kept up with inflation over the years. So what do you do if you want to contribute more than $25,000 or $30,000 or whatever, $50,000 a year? that's where a cash balance plan would come in. This is a defined benefit plan that looks a lot like a defined contribution plan. It can be more visible and potentially more valuable to younger and more mobile workers. Employees see an individual cash value, and they can take their accrued cash value benefit with them when they leave their employer, provided the plan allows it. However, unlike a defined contribution plan, the employer's interest credit applied to a cash balance account isn't related in any way to the plan's investments. It's defined in the plan document. The plan may define interest as a plan investment return. So a little bit more, again, like that kind of Social Security kind of idea a little bit. Each employee sees an individual cash value accrued benefit. Additions to each account are based on percentage of pay or flat dollar amount. Accounts are credited with an interest rate specified in the plan, and they're generally guaranteed by the Pension Benefit Guarantee Corporation. An ESOP, or Employee Stock Ownership Plan, these are businesses that use these plans as a means to borrow money, buy or sell, all or part of a business, and save on taxes. So these are flexible vehicle. They can come with some very significant tax savings, and these tax benefits can be utilized to help fund the sale. Finally, we come to our non-qualified plans. There are testing plans that go along with qualified retirement plans. Sometimes, though, employers may want the option to give additional retirement benefits to owners, executives, or key employees. And that's where a non-qualified plan comes in. These plans can use several different designs, including defined contribution or defined benefit, employer or employee contributions, and tax advantages to the company or employees. So you could have a scenario where the individual, the executive, is participating in the defined contribution plan, like a 401k. Maybe it has a safe harbor, or maybe it doesn't. But on top of it now, this executive can defer compensation on a tax-deferred basis to be reaccessed at some time in the future, such as in retirement. Now, tax-exempt organizations, such as nonprofits, also can have a plan. And real original here, it's called a 403B plan. It's really just a couple pages back from the 401k plan in the IRS code. So it's a lot like a 401k plan, but it's for employees of 501c3 charitable organizations, such as schools, churches, and religious organizations. It offers optional employer contributions, fewer testing requirements. You can put an eligibility requirement on the employer contributions. And for this year, 2018, employees can defer up to $18,500 per year. 457 plans, that's not a gun, 457, no, this is a 457 plan. There's two types, both are non-qualified deferred compensation plans, and they are designed again to help government and tax-exempt organization employees save beyond the limitations of 401ks or 403bs. There's two different types. One is called an eligible plan, and another is called an ineligible plan. Again, these are typically available to most employees, while tax-exempt 457B plans are for key employees. And the 457F plan are only for highly compensated employees, usually managers and executives. The 457 plan has an $18,500 contribution limit for 2018 for both employer contributions and employee deferrals. However, take note of this, the 457 plan does not have any contribution limits. Wow. Vesting refers to if and when the employee gets to keep their contributions if they leave the company. The 457B plan usually has immediate vesting, while the 457F plan contributions only vest upon a specific date or event, such as a combination of age and service, which is outlined in the plan document. Now, when you have one of these plans, you have the choice of, and when I say these plans, what we're referring to here is predominantly only those larger plans like 401ks, 457s. This really doesn't apply to a SEP IRA or a simple IRA, those individually owned plans. So what is a bundled service model? Well, a bundled model is where there is perhaps a singular company who is performing all of these tasks: participant education, the processing of distributions, investment selection and monitoring, investment services, transition services, etc. So this is called a bundled plan or a bundled service model. You could go to one company and they will do all of these things for you. Okay? Conversely, you could also go with I'm sorry, I skipped ahead here. The advantages of the bundled model are essentially one-stop shop. Simplified approach may save you a lot of time and expense. You're not calling 2 or 3 different people to figure out an answer to an investment question, a plan design question, a contribution question, a disbursement question. You know, you can go to one person instead of making 10 different phone calls. Now, the non-bundled model is called a TPA. And what does that mean? That means that instead of bundling everything together, you may have different participants. You could have a plan sponsor with a financial advisor. Then you can have a TPA or third-party administrator. And then you can have a service provider processing and handling the education, record-keeping, investment services. So why would you want to have that? Well, with a bundled plan, you could end up with a company. You know, you're in North Carolina and the company's in New Jersey or Phoenix, Arizona, and you know you're not going to see those people perhaps very often. In some cases, for a large corporate presence. Conversely, you could select a local third-party administrator and maybe a local plan provider. So it just gives you a little bit of localization to it. Okay, so some of these advantages of being able to receive a site visit from one of these plan providers. So what are the next steps? Well, you don't need to fill out the attendance sheet or the evaluation form, but I will share with you that I am this has been recorded and it will be uploaded to my YouTube channel, and you can reach it by going to BriantSikorski.com, click on that little YouTube icon, and you can watch this again at your convenience.